Right, and for more insights, I'm joined by Gaura Sengupta, Chief Economist at IDFC First Bank, and Rajani Sinha, Chief Economist at CareEdge Ratings. Thank you very much to both of you for taking time out to speak to us today.
Thank you.
So I'll start with you, Rajni. Do tell us, now that we've had some time post the policy, what your key takeaways were, and also I want to understand, from a few months back up until now, just given what's transpired in terms of GDP growth domestically and inflation, alongside a whole host of global developments, are you expecting a deeper rate cut cycle?
So, Pallavi, my key takeaway from this meeting is that RBI is clearly focused on supporting growth. And that's very apt at this point in time because in midst of this global turmoil, there are growth concerns. In fact, if we look at the trade war, India is relatively, less exposed to external sector. So in that sense, we are mainly domestic driven economy. So the impact would be relatively less than, say, compared to other economies like, say, Thailand, Vietnam, where the export to GDP ratio is much higher. But having said that, definitely there would be an impact of the tariff, and we have estimated the direct impact to be around 0.2 to 0.3% of GDP. And this I'm talking just about the direct impact of tariff. If you take into account whole lot of other indirect impacts that can happen, as overall global growth slows, investment and consumption sentiments get impacted because there's heightened uncertainty, and in midst of that, it's most probable that investments would slow down. I'm talking about global investment as well as domestic investments. So definitely growth is going to be a concern, and that's what RBI has emphasized on. And in fact, RBI has trimmed the growth forecast to 6.5% for FY26 from their earlier estimate of 6.7%. But we feel that the dent on growth could be deeper. We are expecting GDP growth of around 6.2% or so for FY26. And that's mainly because of this global turmoil, and also because of this heightened uncertainty, because of which a lot of aspects, especially related to investment, could just come to a standstill. So hence, growth would be the main concern. There are talks about also the aspect that the tariff on reciprocal tariff on India is relatively lower than what we have seen for many of the other competing countries like, say, China, Vietnam, Bangladesh, and hence there's a window of opportunity for us there. So to some extent, I would agree with that. Yes, definitely there is a window of opportunity for us. There is scope for us to increase our market share for some of these export items. But we have to take into account that it will not be very easy for India to tap into this opportunity. So it would not be a very simple game where they lose market share and we gain. Hence, it may happen in the long term, but I would say in the medium term, I would definitely be concerned on the growth front.
All right. Okay. Coming to you, Gaura, again, the same question in terms of the terminal rate. What is the terminal rate looking like at this point? And also, Rajni just spoke about growth in FY26 and the obvious downside risks to growth at this point. I do want your view on that, but also in terms of what you've been picking up in Q4, what can we expect? Because we did see high frequency indicators throw up mixed signals. So what was the takeaway from Q4?
Sure. Thank you. So I completely agree with the points made by Rajni. This particular policy, the governor basically put growth on the forefront. He's done everything that is required to ensure that the efficacy of the monetary policy is increased. So right from December onwards, they started focusing on increasing the liquidity infusion in the economy. They started with a CRR cut, then they continued with OMO purchases, buy-sell swaps. If you look at the cumulative liquidity infusion that they have done from December to April, including the remaining announced liquidity infusions, it's around 6.8 trillion.
So the fact that they have already on front foot infused liquidity, given us back to back rate cuts, one in Feb, now one in April, indicates that they are doing whatever it takes to increase the efficacy of monetary policy. And I think apart from the rate action, which was expected, what I really found insightful was the post policy press conference, where he indicated what he sees as sufficient liquidity, which is basically a surplus of 1% of NDTL, which would imply around 2.6 trillion of surplus banking system liquidity on a consistent basis to enhance transmission. And the governor also mentioned that if more is required, they will undertake, they will do the needful. So the focus is on growth, focus is on making sure that the monetary policy's transmission mechanism is made as fast as possible by provision of adequate banking system liquidity. Towards the end of last year, there was this lot of uncertainty about liquidity provision. Monetary policy had gone too tight, both in terms of real rates as well in terms of liquidity provision. Now there is a clear gear shift. The monetary policy is moving towards accommodative, as the stance change indicates, and also the fact that they have given us an indication that they will keep system liquidity at around 1 trillion, so around 2.6 trillion or 1% of NDTL surplus, to make sure liquidity transmission happens. The change in stance basically indicates that the rate cut cycle is likely to be deeper. Our expectation is for another 50 basis points cut. Again, we advocate for a back-to-back rate cut because of the transmission lag. So the governor himself stated that it takes around 6 to 9 months for transmission of the policy rate changes to affect the economy. So it makes sense when you are having downside risk to growth to do back-to-back rate cuts rather than spread it over a longer time period. The risk of the rate cut cycle being deeper than, let's say, another 50 basis point cut in the remainder of 2025 is also there. That will really depend on how badly the tariffs affect global growth. Right now, the RBI has, and again, there was a lot of discussion on tariffs, and they also onboarded some of those risks with a downward revision in their forecast. But the GDP forecast for FY26 was already slightly on the optimistic side at 6.7. So the moderation to 6.5, I don't think fully incorporates the risk from tariffs. Our estimate of tariff impact is around 0.5 percentage points on growth, because this takes into account the fact that if you see in terms of domestic value added content of our exports to the US, that's around 4% of GDP. It's higher than when you take the metric of India exports to the US, that's around 2% of the GDP. So depending on which metric you use, you'll get a slightly different impact on growth. So if you work with a 0.5 percentage point impact, implies that if, let's say, RBI's baseline is around 650 for GDP growth, if you really bake in the tariff impact, it should be closer to a 6%. Even you look at the monetary policy report that came out with this policy, the global growth assumption in the baseline models is around 3% for this year, which is similar to last year. So they haven't really baked in the tariff impact. So suppose the Trump tariffs, the escalation that we have seen currently with 27% tariffs on India, right now we have 104% tariffs on China. If it persists, there's definite downside risk to RBI estimate of GDP, definite downside risk to global growth. And you can have a longer rate cutting cycle. But I want to give one caveat. We have to observe what the Fed also does, because right now what's happening is the tariffs will have a real inflationary impact in the US. If you input all the tariffs that the US has applied, impact on core PCE, which is basically the inflation metric that the Fed targets, will be around 2% percentage points. So their core inflation will go towards 5%. Their target is to get core inflation to 2. So how the Fed is able to cut interest rates, even though there is a good chance that the US could go into recession, when we are actually going to experience an inflation shock, also needs to be monitored. So again, it was a great policy. It was a measured response of 25 basis points. The accommodative stance indicates the policy focus is completely on growth with inflation pressures behind us.
Okay, all right. Coming back to you, Rajani. So, given the sort of uncertainty we've been talking about, while there does seem to be a fair bit of clarity in terms of the rate cut cycle, at least up until the next meet and the one maybe possibly beyond that as well, can we also expect the RBI to sort of use any unconventional easing tools? I don't know, maybe for instance, easier, lending norms or anything along those lines. Anything that we can expect going forward in terms of unconventional measures that the RBI might sort of need, especially given that the onus does appear to be on the central bank and on monetary policy to sort of help lift growth?
Pallavi, at this point in time, firstly, if we talk about rate cuts, yes, market has factored in another probably 50 basis point rate cut. And we feel that there are chances of even deeper rate cuts, and that would really depend on how this global trade war pans out. Because there's a lot of uncertainty right now in midst of all the retaliation that we are seeing as to what is going to be the overall impact of this on global growth. But one thing is for sure that even if this uncertainty continues to linger, which is probably going to continue for a few months for sure, that is going to have severe impact on growth. So, given this situation, right now, while we are also talking about, a 50 basis point rate cut for sure, but we feel it could get deeper if the dent on global growth is very severe. Secondly, if we talk about other measures, if you see RBI in the last few months have been announcing some other measures to facilitate credit growth. So even in terms of risk weights that were increased for unsecured lending, that risk weights were also reversed. More so, as Gaura highlighted, there has been a lot of focus on ensuring that there is ample liquidity in the system. And here, when I say ample, actually the central bank would be looking at surplus liquidity, because otherwise the whole purpose of cutting rates, of having accommodative monetary policy, will get defeated unless unless the transmission happens by banks. So in that sense, I think RBI has been announcing some measures to ensure, apart from the rate cut, there have been other measures announced to ensure that there is ample support for growth. And actually, the point is that apart from central bank, we are also seeing that the government has also done some bit on their part to ensure that the growth is supported in terms of reduction in income tax burden that we saw last year. And given that the government has constraints on the fiscal front, and there would be limited scope for them to give further fiscal stimulus, it would be important for RBI to see on their part how they can support growth, and also how do they ensure, it will be very critical for them to ensure that the policy rate cuts that they announced are transferred by the banks in the form of lower lending rates. So I think that's what the focus of the central bank is going to be going forward.
Right, got it. Okay. I'll come back to you, Gaura. So, we've been talking for a while about, again, the downside risks to growth. And while there is an obvious and direct impact in terms of exports, given that we're already a little shaky in terms of private capex picking up, and given the uncertainty currently globally, do we then expect a hit on private capex as well?
So private capex has not really picked up. We've been expecting private capex pick up for the last couple of years, because if you look at the conditions for private capex, it's quite good. You've got bank balance sheets, you've got NPAs levels in banks at a historical multi-year low. You see corporate balance sheets are in much better shape post-COVID. so the conditions, the fundamentals were always in place for private capex to kick in. But what has happened is, if you're a company, you will not add fresh capacities unless you have visibility on demand. So even when you remove the noise from tariffs, even before the tariff escalation, growth in India was already beginning to moderate a bit. If you look at the urban side, real urban wage growth in FY25 has moderated to low single digits. It was in the first half of FY24 in double digit growth in terms of real wage growth. Now, you're already beginning to see the impact of it on high frequency urban wage growth, FMCG sales, volume growth, car sales, etc. Look at listed company performance. So, a company profitability is also moderating because sales growth has not really picked up. A large part of the profit growth that happened in FY25 or in FY24 to be precise, was because input cost pressure had gone down and they really helped listed company profit growth. Now, the help from input cost pressures easing, that was on the lower side in FY25, so you actually saw profit growth slow down. So unless companies see visibility on demand, especially even domestic, and now look at what's happening on the external front, external demand, India's merchandise exports, they will have a tougher time in this sort of high trade barrier environment. Private corporate capex will remain cautious. So the impetus stays with the government of India, with state governments. And what happened last year in FY25 is that we saw a slowdown in central government capital expenditure. Some blame the elections, some say there was very high months because of intensity of the monsoons that impacted the government expenditure in the first half. The state government level, we saw even a sharper decline in capital expenditure. Again, the fact that we had elections in few key states was also one of the reasons. Now, it's very important in an environment where private corporate capex is going to stay tentative, that the government goes, maintains the focus on capital expenditure. In the union budget in FY26, there is an increase in capital expenditure in growth rate terms. They are now going to maintain it at par with nominal GDP, so it's around 11% growth in central government capex. Even state government, you look at their FY26 budget, they are budgeting for an increase in capital expenditure. So in this sort of environment, I think the onus is both on monetary policy. Monetary policy has to ensure that interest rates remain, real rates remain within the neutral zone. Right now, you look at the interest rates, even at a 6%, which is post today's rate cut, repo rate, the real repo rate, taking 4% inflation for FY26, is still 2%, which as per RBI is above or is in the contractionary zone. It's not really neutral monetary policy. As per RBI's own assessment, neutral policy rate is somewhere between 1.4 to 1.9. So so monetary policy needs to reduce interest rates, get the real rate to the neutral zone. Liquidity infusion is key because one of the reasons why deposit growth has been a little bit constrained is because of the fact that there has been a slowdown in reserve money growth. Liquidity infusion last year, the liquidity regime in last year was on the tighter side. So before December, we had very large banking system liquidity deficits. So this liquidity infusion that RBI is doing will be important for not just transmission, it's also important for supporting deposit growth, which in turn will support credit growth. So right now, both monetary policy and fiscal need to work together and to support at least domestic growth, because externally the environment is only getting worse with the tariff escalations.
All right, thanks a lot for those insights, Gaura as well as Rajani, and thank you so much for taking time out to speak to us. That's all the time that we have on this edition of Profit 360, but do stay tuned to NDTV Profit, lots more coming up.